Imagine waking up tomorrow to find that your money has been working for you all night. While you slept. While you dreamed. While you did absolutely nothing. Sounds like a fantasy? It's not. It's exactly what happens when you own the right piece of paper. But here's the catch. 90% of people have no idea which paper actually prints money. And which one burns it. Today, I'm pulling back the curtain on the financial instruments that built empires, crashed economies, and made ordinary people millionaires. Welcome to the world where a single certificate can be worth more than a house or absolutely nothing. Before we dive in, let me be clear. This isn't your boring finance class. No textbooks, no sleep-inducing lectures. We're talking about the actual tools that move trillions of dollars every single day. Stocks, bonds, derivatives, hybrid instruments, each one is a different weapon in the wealth-building arsenal. And by the end of this video, you'll know exactly which one fits your financial goals. And which ones to run from screaming. Let's break down the 5 major types of securities that dominate global markets. First up, equity securities, better known as stocks. When you buy a stock, you're not just buying a piece of paper. You're buying a slice of a real company. Apple, Tesla, Amazon, you can own a piece of them. Here's the psychology. People love stocks because they offer unlimited upside. If you'd invested $1,000 in Amazon in 1997, today you'd be sitting on over $2 million. But here's what they don't tell you in the brochures. Stocks can also go to zero. Enron. Lehman Brothers. Companies that seemed invincible. Until they weren't. There are 2 main flavors here. Common stock gives you voting rights and potential dividends, while preferred stock skips the voting but puts you first in line for payments if the company goes bust. The key question is not, should I buy stocks? It's, which companies will still exist in 20 years? Next. Debt securities, the boring uncle of the investment world, also known as bonds. But don't let the reputation fool you. Bonds are how governments and corporations borrow money from you. You lend them cash, they pay you interest, and, at the end of the term, you get your principal back. Sounds safe? It usually is. US Treasury bonds are considered risk-free, though nothing is truly risk-free. Here's where it gets interesting. When interest rates rise, bond prices fall. It's like a seesaw. And right now, with central banks playing tug-of-war with inflation, bond markets are more volatile than they've been in decades. Corporate bonds pay more but carry default risk. Municipal bonds offer tax advantages. Junk bonds? They're called that for a reason: high yields, high probability of tears. The smart play isn't avoiding bonds, it's understanding the interest rate cycle before it crushes you. Now we enter the casino: derivatives. Options, futures, swaps. These don't represent ownership of anything real. They're contracts derived from underlying assets. And they're where fortunes are made and destroyed in the same afternoon. Warren Buffett called derivatives financial weapons of mass destruction. He wasn't wrong. But he also uses them. Here's the paradox. A call option gives you the right to buy a stock at a set price. Risk? Limited to what you paid. Reward? Theoretically infinite. Futures contracts lock in prices for commodities, oil, wheat, gold. Farmers use them to hedge against bad harvests. Speculators use them to bet the farm. Sometimes literally. The danger isn't the instrument itself. It's the leverage. With derivatives, you can control $100,000 worth of stock with just $5,000. That magnifies gains by 20x. It also magnifies losses. This is where amateur investors become cautionary tales. Meet the chameleons, hybrid securities. These are the financial Frankensteins that combine features of stocks and bonds. Convertible bonds start as debt but can transform into equity if conditions are right. Preferred shares we mentioned earlier? They pay fixed dividends like bonds but represent ownership like stocks. Then there are REITs, real estate investment trusts. You get the income from commercial properties without the headache of being a landlord. These instruments are designed for specific psychological profiles. Investors who want income stability but don't want to miss the growth train. The complexity is the trap. Hybrids often have embedded options, call provisions, conversion ratios that change based on stock price. You think you're buying simplicity. You're buying a puzzle. Read the prospectus, every single page, or pay someone who will. Finally, the exotic section, alternative securities, and structured products. Asset-backed securities, where your return depends on car loans, credit card debt, or mortgages. Remember 2008? These were the stars of that horror show. Exchange-traded notes, or ETNs, track indexes, but carry the credit risk of the issuer. If the bank fails, your safe index tracking goes poof. Then there are certificates of deposit, money market instruments, treasury bills, the cash equivalent category. They're not sexy, but in a market crash, they're the lifeboats. The sophisticated investor doesn't ignore these, they use them strategically. Cash isn't trash when everything else is falling 30%. The key is understanding liquidity. How quickly can you turn this paper back into spendable money without losing your shirt? So how do you choose? Here's the framework nobody taught you in school. First, time horizon. Need the money in 2 years? Stay away from stocks. Have 20 years? Bonds will likely underperform inflation. Second, risk tolerance, not the theoretical kind, but the can't sleep at night reality. Third, correlation. Don't put all your eggs in one asset class. When stocks crash, bonds often rise. When inflation hits, neither helps, time for tips or commodities. Fourth, cost. Every security has drag, management fees, transaction costs, bid-ask spreads. A 1% annual fee doesn't sound like much until you compound it over 30 years and realize it ate 26% of your potential wealth. The best security isn't the one with the highest return. It's the one that gets you to your specific goal with the stomach you actually have. Here's the truth. Information without action is just entertainment. You now know more about securities than 95% of the population. But knowing isn't owning. Pick one type we covered today, just one, and open your brokerage app this week. Buy your first stock. Your first bond. Your first ETF. Feel what it's like to have your money working while you sleep. Or don't. Stay in the 90% who wonder, what if, 20 years from now? The choice is always yours. But if you're ready to stop watching and start building, hit that subscribe button. Drop a comment with which security you're researching first. And smash the notification bell, because next week, we're diving deep into the dark psychology of market bubbles. You won't believe how predictable the next crash is. Until it's too late. See you then.